So today, I'm going to bring to the surface what most insurance professionals do not want to talk about. Most don't even want to hear about it. But to understand why this is such a hot topic, you must understand how we got here. Here we go. To understand why the FCC even woke up to the recent TCPA crackdown, we need to break down the shady operations that have been going on in the insurance sales playbooks. We've stated this before. The insurance lead generation world has been flying beneath the FCC's radar for several years. So why now? Some event must have triggered some exposure, right? Yeah. An event such as the coronavirus pandemic would do it. In response to the COVID-19 breakout, along with the lockdowns and the self-quarantines, insurance regulators basically suspended any in-person wet signature requirements for submitting insurance applications. Naturally, this opened the floodgates for insurance agents to supercharge their outgoing calls. This also accelerated developments of insurance applications to include digital signature capability to accommodate remote consultations carried out over the phone lines. New signature capturing methods expanded from the DocuSign style signature to now include dedicated email links and even text message verifications. Gotta love technology. Insurance sales by a single agent elevated to new levels with the capability to consult, write, and submit a multitude greater volume of insurance applications within a single day. Gone were the requirements for insurance agents to schedule office meetings or drive to in-home consultations to collect wet signatures in person. Furthermore, the number of consultation appointments per day could now be drastically increased. And if you have a no-show, who cares? The next appointment opportunity could just be a few seconds away by dialing up another prospect. While this is great for cross-state border sales and agents looking to increase their geographical reach, like anything, moderation and responsibilities must apply. And since we're talking about this right now, apparently that hasn't really been applied. So what's the issue? Well, insurance agents are now vastly making more phone calls, adding to the already bloated number of nuisance telemarketing calls received by a very agitated consumer base. Reminder, TCPA laws were enacted to protect consumers from unwanted solicitation phone calls and text messages. With insurance agents getting the green light to make telephone sales, unsurprisingly, insurance solicitation phone calls skyrocketed as well. Now, it's not simply a matter of an agent dialing up prospects. The use of automated technologies, including AI technologies, rapidly started to make their way into an insurance agent's operations. Auto dialing software use and development has surged over the last few years. Here's some stats. The global predictive dialer software market was valued at only $1.03 billion in 2020. And it is expected now to reach $12.2 billion by 2028. That's an expected compound growth rate of 36% each year. An average agent is now enabled to more than triple its call volume on dial days. And when we consider the thousands of agents across the industry, that's a lot of telephones ringing. Furthermore, for 2025, it has been reported that 78% of insurance organizations plan to increase their budgets for the adoption of advanced tools such as auto dialers, messaging campaign software, and even these AI technologies. This is great, except for the pesky regulation put in place by the FCC, such as the TCPA laws. Until lately, the increased unwanted solicitation remained rather quiet. Lawsuits would occur, but nothing made enough waves to disrupt the waterhole. But the number of complaints received by the FCC paralleled the increase of call volume. The crescendo was more than the FCC could ignore. Until this recent activity, The 2012 definition of prior express consent was practically overlooked, as the vast majority of insurance professionals didn't even know it existed. Of course, with the spike in complaints, the FCC responded with a series of rulings that sought to regulate these new automated technologies. All right, let's recap. Allowing remote insurance sales led to increased phone calls. Increased phone calls led to increased demand in automated technologies. Automated technologies opened up the capability of insurance agents to blast the consumer base with literally hundreds of phone calls and text messages within a single day. Plus, this could be done with little to no effort, as the software and AI have become so advanced that these events are activated by triggers built into the automation. Most of these communication events occur even without the physical effort by the agent. It's a numbers game, right? Sure, the increased opportunity should increase overall sales. I mean, even with a low conversion rate, all an agent would need to do is throw more leads into the CRM and increase the frequency of outgoing calls and messages. Who cares if the consumer gets angered and annoyed? Just allow the software to hang up and continue its job blasting the database until an actual interested party is on the line. Now let's add the lead generator's contribution to the circus. An unwitting consumer fills out an online form with the expectation of being contacted by a licensed life insurance agent. And just like that, that consumer just inadvertently consigned to receive solicitation efforts for the next decade at a minimum. Whether they consented or not, the nonstop attempted communications are coming. Personally, I have not filled out a single online form. I know how it works. However, I am currently receiving 10 to 13 unsolicited phone calls each day from health and life insurance agents. Yeah, I'm counting. The lead generators capture the data, sell it to the big IMOs who are buying up agencies with a high volume of agents. Got to have someone to which to sell the data. And the lead is sold in descending rates in perpetuity. Freshly generated leads carry the highest premium, then the downgrading begins, and the data is sold again and again with a descending price tag at each age interval. I agree that the FCC overstepped its statutory authority with the one-to-one consent rule, and I commend the IMC for throwing up a petition to intervene. It definitely would have punished the ethical lead generators out there and put them at high risk of landing themselves in a hefty lawsuit. So thank you. And very clever taking this to the 11th Circuit Court. Nice strategy. But I'm not 100% on board with the oral argument made by the petitioners to the court which vacated this rule. The basis claim consumers who actually wanted to be contacted would be deprived of their opportunity to receive the service they requested. I'm not so convinced that the motive is that pure. The aged lead selling market possibly accounts for the majority of revenue for most of the big insurance IMOs, not insurance. The one-to-one consent rule would eliminate their ability to legally resell lead data after the first sale. For those guys, that's a lot of revenue loss. I'm just going to leave that right there for now. I get it. A business needs revenue, and no business wants to experience revenue loss. But at what expense? A very antagonized consumer base? One of my law professors taught me something that has made more sense to me as my career continues. He simply said, the reason laws are made is because people get mad. How true this is. For this reason, I don't believe it's over. I don't believe the FCC is finished here. The one-to-one consent rule has been vacated, which means it's basically gone forever. But so long as my law professor's statement is correct, we'll very likely see some new regulatory attempts in the future. Consumers receiving these insurance high-volume automated solicitation communications are not going to stop filing complaints. But for now, the chips have fallen. At least now we have some clarity on where the chess pieces rest on the board. The finance and insurance industry is a necessary service provider to the public. My message: let's do this ethically. I don't like regulation as much as anyone. Government agency overreach is the least appealing concept I can name. But oversight is crucial. We can do this without a strict regulatory environment. But agencies, IMOs, and the carriers must invest in ethical practices as much as they are in AI technologies. As they say in the South, keep it between the ditches. A proper balance will ensure long-term growth without the crushing lawsuits we learned about with the Assurance IQ case. Until next time, stay ethical.